Inflation seems to be the number one risk that market strategists are flagging as I've made my way through 2026 Outlook reports. So in this video, we're going to get a better understanding of the role of inflation in the business cycle and talk a little bit about why so many people in investing are concerned that a reacceleration in inflation could be on the horizon. So, why has inflation been such a big deal in the last few years, and why do people care right now? So, right now, part of it is because there's a lot of potential tailwinds to inflation. One, the Fed is dramatically cutting interest rates. We don't know how much longer that will continue into the future, but over the last about 18 months, we've seen almost 200 basis points worth of interest rate cuts. That is generally inflationary. The second reason is because we have really constrained our labor supply via deportations and a lack of immigration into the US. Lower labor supply equals a greater chance for wage inflation. And then finally, restrictive trade policy tends to be inflationary, as you're generally not sourcing goods in the cheapest manner necessarily, or you're adding to the price via things like tariffs, for example. Now, why has this been such a big deal over the last few years? Well, investors are generally untrained and unfamiliar with inflation, and that's simply because we haven't had to deal with it for a very, very long time. So, if you look at this chart, this uses US core PCE. We're going to cover a bunch of different inflation metrics on this. In the next slide, we'll have a table that will be a quick little overview. But investors have basically become accustomed to a world in which inflation has been a non-issue. So if you look from the 80s to about the mid 90s, inflation was consistently falling. So over that 15-year period, investors were used to periods of falling inflation. And even the spikes that you do see on the chart tended to be temporary and short-lived. And that led to what we call the Great Moderation in the early 2000s, all the way to about COVID, where inflation wasn't really a relevant risk for almost 2 decades. And obviously, that changed in a big way in 2020 and 2021, where you see the spike in this chart. Now, that has obviously moderated a little bit since then, but we are still looking at high twos, low threes, depending on the measurements that you use. And that is much bigger than the 1 to 2% that investors were used to over the last 2 decades until the spike around COVID. So there's many different ways to measure inflation. We're going to cover a few of them throughout this video, but just to give you a little high level overview, the thing you're going to see the most quoted in financial media is going to be the Consumer Price Index, or CPI, and that measures the changes in prices urban consumers pay out of pocket for a fixed basket of goods and services. So this is viewed as a cost of living style gauge. So what are you actually spending money on out of pocket? Then you have the Producer Price Index, PPI. That measures the price changes received by US producers at the wholesale level. So that gives you a read on pipeline inflation pressures. Then you have the Fed's preferred gauge of inflation, which is the Personal Consumption Expenditures Price Index, also known as PCE. That's what you saw in the last chart. So that measures inflation for a broad set of consumer spending categories, and that includes items that are paid on the household's behalf. So sometimes by the government, sometimes by companies, like healthcare. Then you have things like the ISM Prices Paid Index, which we mentioned quickly in our PMI video. I'll find a way to put up a link in one of the corners to that video if you want to check it out. That is a survey-based index showing whether input prices really early on in the economy are rising or falling for businesses. So it's a timely signal of inflation pressure. Then I will mention there are also core versions of most of these series. And so when you see core CPI or core PCE, etc., what that's basically doing is that's removing food and energy prices from their calculations, because as we'll talk about in a little bit, those two categories are particularly volatile compared to the others. And then there's also some really fun alternatives. So there's informal proxies. You've probably heard of some of these, like the cost of Thanksgiving dinner or the Big Mac index, where they measure I think it's the Economist who has the Big Mac index. They measure the price of a Big Mac across countries over time. It makes inflation a little bit more tangible. Instead of a basket of goods, you're measuring against the price of a Big Mac or, the 5 ingredients, 6 things that go into a Thanksgiving dinner. And it makes it more tangible, but again, we're not really making investment decisions based on these indexes. So, what are some of the main drivers of, in this case, headline CPI? Well, it starts and ends basically with energy, and that's due to the extreme volatility of energy prices. This gives them a disproportional influence on overall inflation. The fact that energy inflation only accounts for 6% of an index like CPI is overwhelmed by the volatility of the series. You'll see some charts on the next page that shows this graphically, but basically this stems from, if you look at the table on the right, the beta of the CPI components relative to headline CPI. It's a little bit, we don't really talk about beta much on these videos, so if it's a foreign concept, don't worry. Basically, what this is saying on the right is energy is incredibly volatile compared to everything else. So while it's only 6% of US CPI, it is the main driver. Some people call it the tail wagging the dog. Last thing I want to point out, you can see the breakdown here where in teal on the pie chart is core. So the entire pie chart is headline CPI, which is core plus energy plus food. And then you have core, again in teal, which is headline minus energy minus food. So as food and energy is the main driver of headline inflation, you can get charts like this. So headline inflation is at the mercy of food and energy prices. On the left, we have plotted headline CPI with just food and energy CPI. And you can see that these charts are almost a 1-for-1 comparison of each other. It is 0.92 correlation. So this holds true for all headline inflation indices in the US, where the volatility of commodity prices overwhelms the influence of virtually everything else. So when you pull out food and energy, and you're left with headline CPI versus core CPI, it's no surprise that these two inflation metrics will often diverge from each other. So you can see periods throughout history where these lines, one, not only do they not fully sync up, but they're moving in completely opposite directions. So it is true that core often will diverge from headline inflation trends because headline is driven so heavily by energy and commodity prices. And that brings you to charts like this, where US inflation trends, again, as we've said, disproportionately impacted by energy. So the relationship between oil prices and US CPI is incredibly tight. Again, this is due to the price volatility of oil. And this explains some of the reason why, again, we do policy here, not politics. But as you've heard President Trump become more and more concerned with affordability as we get closer to midterms, it's not surprising he's taking some actions with the intended goal of increasing the supply of oil over time. As you look at the clip chart on the right, this is a period where the impact of oil or the use of oil is supposed to be falling as we've unlocked different types of energy sources, renewable energy sources, electricity, solar, etc. We're supposed to be relying less and less on oil. However, the relationship is just as strong. So if President Trump can find ways before the midterm to lower oil prices, based on this relationship, you would expect to see a flow through to a lower inflation number. Now, we've talked only about energy and commodities this far in this video, but I don't want you to think that those are the only drivers of inflation. There are a lot of other inflation influences that impact inflation in their own way. Now, if I had 3 hours here, I could go through all of these. And that is exactly what we do in Chapter 3 of the Macro Specialist designation. We dedicate sections of this chapter to all of these influences. So we have China. China's growth swings have massive effects on the global demand for commodities and energy. So as China's growing, the demand for energy and commodities rises, which increases the price of those things. And again, when energy, as we've talked about, gets more expensive, inflation in the US tends to perk up. And then obviously vice versa when China's economy is contracting or growing less slowly. Then you also have the US dollar. So a stronger dollar tends to lower import prices and a weaker dollar raises them. So when the dollar is really strong, we're able to import goods for less amounts of money. When input costs are lower, that tends to decrease overall inflation. And again, vice versa when the dollar is weak. By the same token, foreign crises have a big impact on US inflation. So global shocks can trigger a flight to safety into the US dollar, pushing its price higher. And again, as we just talked about, a stronger dollar tends to lower import prices. Then you have things like the weather. So weather disruptions, whether they be droughts, freezes, hurricanes, can hit the supply for food and energy that cause short to medium term spikes in prices. These generally aren't long term impacts, but they can have an impact over the short and medium term. And then finally, the Fed. We're going to touch on the Fed a little bit here in terms of how they react to inflation, but they also impact inflation. So by tightening or easing financial conditions, the Fed influences demand for goods, the demand and availability of credit, and inflation expectations, which all impact inflation. So if you want to go more in depth on this topic, I highly encourage you to scan the QR code that's in the bottom right here of this slide. That will bring you to our website where you can learn more about the macro specialist designation, which is the only macro investing professional designation program. And again, in Chapter 3, we go very in depth on all of these topics. Okay, so back to the video. Inflation plays an important influence on the business cycle and therefore economic growth. So we can really start anywhere here in this little circle, but the TLDR is a rise in commodity prices, mainly via its impact on the consumer, eventually becomes a headwind for the economy. In due time, this causes a slowdown in economic prospects, and that results in lower commodity prices. And these lower commodity prices eventually set the stage for an economic recovery. So we'll start here in the bottom left-hand corner with lower inflation. So as a slowdown in economic prospects ensues, the demand for commodities and energy decreases, and that leads to lower prices. Eventually, the prices get so low that people become interested again, and this sets the stage for an economic recovery as people start spending money, buying goods, building things, starting companies, etc., due to the cheap prices. As the economy starts to improve, more and more people are buying up things that leads to higher inflation. Commodity prices in particular, because that's the theme of this video, typically soar following a trough in the business cycle. So again, as the economy grows, demand for energy and demand for commodities increases. Eventually, the prices get so high that they constrain growth. And so higher inflation pressures in the US eventually lead to slower growth. And then we're back around the circle. That slower growth, the slowdown in economic prospects leads to lower commodity prices, and around we go. So inflation has a huge impact on the business cycle and economic growth. As such, so we're going to talk a little bit here about the specific dynamic in consumer-driven economies. Now, this is a bit of a complicated chart, so I'm going to give you a high-level overview, and then I'm going to go a little bit more in depth because it's a very, very important concept. So the high-level overview. Basically, there's a trade-off in the US and other consumer-driven economies between food and energy spending and the strength of the US economy. So, when consumption spending is depressed by high food and energy prices, GDP growth tends to be weaker, and the opposite is true when food and energy spending is lower. So first thing to point out on this chart, the size of the bubble equals real GDP growth percentage. So the bigger the bubble, the larger the GDP growth of that year, and the smaller the bubble, the smaller the GDP growth. And if you notice, the larger bubbles all tend to be located in the lower right-hand quadrant of the chart. What is the lower right-hand quadrant? That is when food and energy prices are contained and consumers are able to spend money on other things and consumption grows rapidly. So this makes sense intuitively. If consumers are spending a larger percent of their disposable income on things like making sure their family is eating, keeping the electricity on, keeping the home heated or cooled, then they're going to have less money and less confidence to go out and spend on non-essential items. And basically, when the US consumer is spending on those non-essential food and energy items, that is when we tend to see the largest GDP growth in the US. Now, I do make note of this, but this is the second video in a row I have not included the pie chart that almost 70% of US GDP is consumption, but I do mention it here in the box. It's not surprising that this is important because 70% or almost 70% of US GDP is consumption. So this is very, very important. When food and energy prices are lower and inflation is lower, consumers are able to spend on other things, which drives GDP growth. And then we have the impact of the Fed. So inflation is half of the Fed's dual mandate. We have growth or employment. So the Fed wants to keep the economy as close to full employment at all times as possible. And they also want to keep prices stable. Traditionally, it's been around 2% inflation is their target. Now, I'm not going to talk a lot about the Fed here because I have a feeling over the next couple quarters, the Fed's going to be a main topic for obvious reasons, especially as Chairman Powell's term comes to an end. But when you're talking inflation, you have to talk about how the Fed reacts to it. And basically what you see is that inflation and the Fed's fund rate are correlated across time. This is not super surprising. So the Fed sort of trades off back and forth between whether they're more concerned with price stability or if they're more concerned with keeping the economy at full employment. So if you look back 50 years, the Fed fund rate and headline inflation have been correlated over this time. So when headline inflation perks up, generally speaking, you'll see the Fed raise interest rates to try to decrease or increase the cost of money, which should help tame inflation. And then vice versa, as inflation starts to drop down, the Fed becomes a bit more concerned with the employment side of their mandate. So they will then decrease interest rates because they're less worried about inflation and more worried about people starting businesses and hiring to keep the economy at full employment. And that's sort of what you're seeing right now is the Fed is a bit more concerned about the employment side of their mandate. So they are comfortable decreasing the Fed fund rate, even though CPI and other inflation metrics still sit above their targeted of 2% mandate. Now, this is about a year old, this Wordle, maybe even a little longer than that. If we updated it, I'm sure it would look different. But the point of this is just to say that during certain regimes and certain times, inflation dominates Fed speeches. So during this period, you can see inflation was used more because we analyze all of the Fed governor's speeches. Inflation was a word used more than even like percent or rate or up, right? Some of these very common words you'd expect generally get used a lot. Inflation dominated the Fed speeches during this time. So there's often a trade-off where the Fed at times is more concerned about inflation, or right now is the opposite. The Fed seems to be more worried about employment, which is why you see them decreasing rates, even though inflation is a bit above their 2% target. It has come down dramatically since the COVID spikes. So they feel comfortable decreasing rates at this time. So that's what I'll leave you with. I hope you enjoyed this video and I hope you have a better understanding of the impact of inflation, what drives it, and why it is important and why so many market strategists are concerned about it right now. If you did enjoy this video, I highly encourage you to subscribe to the channel, and I will see you next week with another educational video. Have a great week, everyone.